Hello and welcome to this week's instalment of Nucleus Investment Insights. This week we turn our focus to the precarious path ahead for the Australian economy, and there is plenty to talk about. For the first time since March 1998, that's 22 years, Australia has recorded annualised deflation as headline inflation for June fell to negative 0.3%. A fiscal cliff also looms for the unwinding of Jobkeeper and Jobseeker, as true unemployment is estimated to be around 13%. A mortgage cliff is also on the horizon, with the ending of mortgage repayment holidays running into the continuing rental reductions and eviction freezes. Here to discuss these remarkable times, we are very fortunate to be joined by a former Senior Policy Advisor at the UK Debt Management Office. He was also a former economist at the New South Wales Treasury and has now earned the rank of Senior Economist for the Commonwealth Bank of Australia. Gareth Aird, welcome to Nucleus Investment Insights.
Thank you, gentlemen. It's nice to join you for a chat.
Fantastic to have you on. Also on the line, we have our own resident economist for Nucleus Wealth and the Macro Business Fund, Leith van Onselen, although he's just dealing with some mic issues, so he'll be along shortly. And our final member joining us to help pull back the curtain on Australia's economy, I'm joined by Nucleus Wealth's Head of Investments, Damien Klassen. Hello, Damien.
Hi, Tim.
Lovely. And just a quick reminder before we get started to subscribe on YouTube and click on the notification bell to be notified of when we go live or have a new webinar to watch. And follow us on your preferred podcast platform. And for those listening in live right now, feel free to drop in your questions in the chat box at nucleuswealth.com/webinar, and we'll get along to answering those along the way. So we'll jump into the agenda for today. So we're going to kick off with the Commonwealth Bank of Australia's internal data on the Australian economy. We'll then be looking at Australia's true level of unemployment, the pending fiscal and mortgage cliffs I mentioned, the role of government in stimulating demand, some views on the Australian housing market, and then finally, of course, the investment outlook and how we use these themes every day here at Nucleus Wealth. So we'll jump into it. So we've got the CBA's internal data, a couple of charts up on the screen here. And what's it saying about the Australian economy? Damien?
So we've just got these ones which I think, which Leith's put together just to show some of our thoughts around what market's doing. And CBA obviously has a number of internal sort of real-time bits of data. And so that, I guess, Gareth, what we wanted to do with is sort of get a feel on I guess wages and government benefits, what you're seeing on that front, on the job seeker front, and then on the state spending as well, where the official statistics are all pretty gloomy. But what are you seeing at the ground level?
Yeah, sure. Look, I mean, our data at the moment is proving incredibly useful for us to understand what's going on in the economy. I mean, we've always had access to it, but week to week and month to month, things don't really move that quickly. And, so we've never had to really rely on it to tell us what's going on right now. But right now, both on the income side and then also on the spending side, it's really giving us a very timely read on what's actually happening in the economy. And I think on the income side, it's been really interesting to understand the dynamics that are actually going on with wages and government payments at the moment, and just how much the fiscal stimulus is actually supporting the household sector. And I can't actually see what charts you've got up there on the screen at the moment, but if you've got the ones there that relate to wages and government payments, what our data is actually telling us is that the drop-off in wages and salaries, which have come about through people losing their job or people working less hours, has to date been more than offset by government payments. So that's primarily job seeker, so the number of people on job seeker, as well as the fact that the payment is a lot higher because of the coronavirus supplement. And then also the other government benefit payments, like those $750 couple of tranches, that the second one's actually hitting low income earners or pensioners' bank accounts right now. And so I think if you didn't look at our data, you wouldn't actually know that dynamic is actually underway. The fact that the government payments have just been so high that they've more than offset the drop-off in wages and salaries. So it's not the full story on household income. It's a partial read, but it covers quite a lot of what is household income. And it suggests to us that, so far anyway, that the government payments have supported the household sector pretty well.
Mm-hmm. I guess it's the interesting question is, how long can they keep it up for? I guess is the real thing, isn't it? So we've added another 6 months to it, at a reduced rate, and I guess you got sort of your thoughts around and some tightening up criteria. I think we had something out the other day on, I don't know if you've seen K&S Corporation, a trucking company that sort of reported a $3 million profit last year and is talking about having a $15 million profit this year, which includes about $12 million of Jobseeker. So,
well, yeah, I mean, I think they had to tighten it up. I mean, when you find out, as we did, I think it was last week, that 900,000 people of the 3.5 million people who are on JobKeeper have actually been earning on average $550 per fortnight more than they were earning pre-COVID, then you realise that something has to be done. And so clearly the government has looked to address that with a few tweaks they've made to JobKeeper that will kick in the fourth quarter. But it's still going to be a lot of support for businesses. And I think that story around household income is not going to look as strong come the fourth quarter of the year. But equally, it's not going to come off as much as I think a lot of let's just say people who are quite pessimistic on the outlook are actually thinking. And I think as well, even on Jobseeker, I mean, the government has obviously reduced the coronavirus supplement, which kicks in at Q4. And again, I think they sort of had to do it when you hear an increasing number of anecdotes around businesses are actually struggling to employ casuals, just given that the Jobseeker payment is pretty high relative to what someone who was earning if they were working 20 hours as a casual. So they had to tighten that up. But they've also said now that the government has said that someone who's on Jobseeker can earn up to $300 a fortnight and still receive that payment. So I think a lot of those changes made sense, and it's pretty clear to me that come early next year that Jobseeker is not going to go back to the old New Start. So the amount of fiscal stimulus that has been announced to date will be increased as we come to those clear points, just like the government has done last week with extending JobKeeper.
And so, I mean, in terms of the JobKeeper side of it, I guess with an economist hat on, initially it's sort of that it made a lot of sense in terms of if this is only going to be a 3-month sort of bit of a shutdown and then start back up again, and you don't want to get people disconnected from the businesses, and you do want to. That's obviously where lots of the harm comes in economic downturns. Is once people are fired, it takes a long time to come back, and if ever, certainly for older people. I guess the question that sort of comes to me is that, well, it's obviously not just a 3-month shutdown. It's obviously a lot longer. And so the question is, after a year, are people still going to be connected to these businesses? Or I guess, what are your thoughts around that in terms of the, it's obviously working quite well in the short term, but what's the long-term implication of keeping this on?
It's a hard one. I mean, the fact that Victoria has gone back into lockdown means that businesses still need, I think, support in the form of JobKeeper, because we're talking about a lot of businesses who are completely viable and they were fine pre-COVID, but obviously if they're told that they can't open their doors to customers, or they've got to do it in some significantly reduced capacity, then they do need assistance. And so I think this second lockdown in Victoria, which could go on for a fair bit longer than the 6 weeks that has been initially announced, means that you need ongoing support, I think, for businesses. So the policy it's not perfect. I think that's crystal clear. But I think given that it's really been government decisions that have impacted businesses in the way that they have, you've got to support them. And providing a wage subsidy, to me, seems like a reasonable policy when you consider everything else that's going on.
Yeah, sure. I guess so. At what stage? I guess from my perspective, I'm sort of looking at it going, okay, well, if this is going on now for a number of years, and it's quite possible that, say, tourism revenue is not going to come back for a number of years. Is this something where we should be paying somebody to sit at home, saying, yes, we want you to sit here and we'll keep paying you for the next year, 2 years, until tourism finally comes back, and then we'll put you back into that job? Or whether we're better off saying, let's put you onto a more of a job seeker type thing, and why don't you go see if you can find another job for the next 2 years, and then if tourism comes roaring back, then then we'll let them worry about competing for employees at that time by raising wages.
Look, I think that's right, and I think that's ultimately what will happen. I mean, JobKeeper won't go on forever, and probably the sort of example you've just given is probably there's probably not that many cases like that now. I mean, if you look at, for example, the data on hours worked, there was a lot of people in April and May who were considered employed, but who weren't actually working, whereas that number came off significantly in June. So I kind of think by the time you get towards the end of where JobKeeper's announced to go on for now, which is the first quarter of this year, I don't think there's actually going to be too many people who are still sitting around working 0 hours and receiving JobKeeper. I think they'll just drop off naturally, and you'll find the government won't actually be supporting all that many people who actually aren't working at all.
Yeah, okay. And so in terms of the spending side then, so you're saying, so yeah, do you want to give us a bit of a flavour? I guess maybe the Victoria versus New South Wales might be a good, or Victoria versus WA maybe? Yeah,
sure. So on the spending side, what we're doing there is we're just looking at all spending basically that's going through on CBA cards. So that's credit and debit cards. And that obviously captures a huge amount of spend, just given most people are paying for things with a card these days rather than using cash. And in fact, just on that, there's been a material shift from cash to card over the past 12 months. With the increased use of PayWave, and that got augmented as a result of COVID, just because a lot of businesses and households don't want to physically handle cash. So we're kind of treating the levels that our card spend is landing at with a degree of caution. But for us, it's more about the direction and the relative performance, if you like, when comparing, say, across states. And what's interesting is that spending, not just as a result of the shutdown, the most recent one in Victoria, but spending basically ever since COVID arrived and we went into a national lockdown, has contracted the most in Victoria. And it never recovered to the levels that the other states were running at right through that period. My sense is that's because Victoria's got an over-reliance on the services sector relative to the other states, particularly relative to Queensland and Western Australia. And so what you're seeing there is that basically Victoria's underperformed the rest of the country right through the COVID period. And then New South Wales is kind of just sitting a little bit above that, whereas Western Australia and Queensland have performed quite a bit better on the spending front.
Right. So is that Victorians drink too much coffee from cafes, whereas others make it at home? Is that?
Well, there's something in that, right? And it all marries up with basically the structure of those state economies. So you've got obviously in Western Australia and Queensland, you've got a higher reliance on agriculture and mining, and those sectors have been far less impacted than large parts of the services sector, which clearly Victoria has a higher exposure to. So all of that makes total sense. But then it's always helpful when you can actually see it coming through in the numbers.
Yeah, it's interesting though as well that New South Wales and Victoria are already quite similar and then they really diverged when Victoria went into this second lockdown. But the drop for Victoria in the second lockdown has been nothing compared to the original drop.
Yeah, that's right. It hasn't, but there is a little bit of a quirk that's sort of gone on, and that's why with this card spend, you kind of got to dig under the numbers, because sometimes you get some funny things going on. And what we saw is in the last week that education spend in Victoria jumped 90% through the year. Now, that's a huge lift, and that's obviously massively inflating Victoria's spend. And I think it has something to do with just the timing around when uni fees have fallen due, or when school fees or something. I mean, I don't have the time to go through all this stuff in great detail, but when I just look at the cut up by the different components that we spend on, education stood out. So it's a one-off thing, and I think when that washes through, you'll actually see a far bigger contraction in spend in Victoria come through.
Yeah. So in these numbers as well, as you said, there's this whole change in terms of the amount that's being spent now on cards versus on cash before. Do you have a feeling roughly what the split was, say pre-COVID in January, versus between cards and cash versus what you think it is now?
Yep. So I did some work around this. It was quite easy to work out pre-COVID because we knew basically what spending in the national accounts was running at and spending, on retail, and we could compare that with our card spend. And basically, our card spend was tracking across the board about up 6% through the year pre-COVID. And you had
sorry,
yep.
What's that as a percent of the total spend?
Total card spend.
Yeah, so I guess was cards 50% and cash 50%, and now it's 75-25?
Yeah, so I was going to say I don't know that relative split, but what I was going to say is we know that basically nominal spend in the economy pre-COVID was growing about 2% through the year, and card spend was growing at 6%. So you could kind of say your card spend is really being inflated by about 4% from the shift from cash to card.
Yep.
Now, it's a little bit hard working out post-COVID because we don't actually have, official data for the June quarter of which we can then benchmark our spend against. But if you do it just looking at what our data is telling us has been happening on retail versus where the ABS official retail numbers have been printing, then it looks to us like that shift from cash to card has lifted the annual rate by about another 6% over the COVID period.
Yep.
So we think that overall card spend is being inflated by about 10% through the year, just based on the shift from cash to card. Now within the different components of spend, you're getting quite a variation in the impact. I mean, for example, at pubs and hotels, there's been a much bigger impact of cash to card, just because pretty much everyone now is buying a beer with their card. But if you just look at the total spending basket, it looks like it could be worth about 10%.
Yeah, Gareth, just a quick one. You mentioned education before, and obviously New South Wales and Victoria are probably the leaders in the education sort of side of things. But I was just thinking more like the foreign education piece, which has probably pretty much gone to zero. There's been obviously a big deficit in the number of foreign students currently. Is there sort of, are you seeing, or would you know much about the gap in that at present?
Yeah, so we can't pick up any of that in our data because you've got to have a CBA bank account to be paying with the CBA card.
Right.
And so if a foreign student arrives and they're, I don't know how they pay, whether they pay before they arrived or they've got a foreign bank account or whatever it is, then we're not actually capturing that.
Okay.
So one of the things we've also been highlighting with our card spend is that, and again, this is another reason why you've got to treat it with caution, is that we're not picking up any of the drop off in foreign tourists, because they're not here in Australia spending with a CBA card. So again, that's another reason why our numbers kind of inflate the overall level of spend, because clearly there is no or very little foreign spend going on at the moment in Australia from overseas tourists, and yet we're not capturing that looking at the annual change. So that's why when we've been talking to clients about this or writing on it, we've been pretty keen not to get too hung up on the level that these things are printing at, but more around the direction. So you can kind of you can capture how big you get a sense for the magnitude of drop off in spend as a result of a lockdown, and then you can see how fast or not spending is actually recovering. And so it's all that direction, and that's where we've been using it. And it's high frequency, but it just gives you a sense, particularly when you drill down in the basket and you cut it up, by the various components of spending, you can see the ones that have been most affected by what's been going on.
Okay, very good. I think Leith's joined us now. Finally, are you there, Leith?
Yeah, I am. Can you guys hear me all right?
Fantastic. Yep, coming through loud and clear.
Oh, fantastic.
Lovely.
So just before we get off this slide, so Leith, we're still on the on this what's CBA internal data showing about the Australian economy slide. The other one I'm really interested in is we've obviously had this shutdown on reduction in terms of people going to get kicked out of their house for not paying the rent. It's very hard to get companies into administration without because of non-payment. I guess it's this whole idea that we've got a lot of companies sort of sitting there with assets on their balance sheet, which is, I'm owed this money from this other company, and they're owed money from another company, and they're owed money from another company, and that at some stage, that the payments aren't going through as quickly, and at some stage, if some of these start falling over, there's going to be this domino effect where companies start, tipping over. I guess, from what you see on your merchant data, do you do you have a feel for how far down merchant receipts are, or I don't know? I guess is there any other sort of small and medium business data that you have in terms of looking at companies that probably, will be if things don't improve dramatically, would be insolvent at current levels?
The short answer is no. Not that I'm looking at. I mean, no doubt there's people in the bank that have that data, but that's something that I don't have a handle on, and I think it's probably one of the bigger unknown things is just what is actually occurring at the moment that is not going to show up, if you like, until several months down the road.
Because I think that's where I'm sort of keep circling back from the investment side, is keep going, well, I can see that it definitely makes sense to say, here's, as you said, here's a restaurant who owes $100,000 because they did a big fit out and their volumes are right down, and so we've given them this short term kicker and a short term Jobkeeper or whatever to get over the hurdles. But if they're looking at being down even 20 or 30% on volumes for the foreseeable future for the next 2 or 3 years, then they're not going to make it, and they're better off pulling the plug sooner rather than later. That's I don't know what your thoughts are on some of those ones.
Yeah, look, I mean, this whole event is so unique that I think you want to kind of tread carefully in terms of how quickly or not you pull the rug out under a business, and I think no one really knows how the path of the virus is going to go and how quickly or not we can get back to doing the things that we did. And I think that it makes, to me anyway, it makes a lot of sense in keeping as many businesses afloat at this stage as possible, because if things do end up improving more quickly than some people think, then you want to make sure you've still got as many of your businesses that you intact. I mean, if you go back to March, for example, and early May when we went into the first lockdown, I think it was fair to say that most people thought that we wouldn't be up and running in most of Australia today like we actually are. I mean, it's obviously a different story in Victoria, but the initial thought is that we might be looking at some version of a lockdown continuing right through for 6 months. So things actually did end up panning out a little bit better for most of the country. And so I think just given how uncertain things are, you just don't want to be too quick to make an assessment on the longer term viability of a business or not. And therefore, to me, it makes a lot of sense where possible to keep as many businesses afloat at the moment as you can.
Yep.
Okay.
Anything to add, Leith? No?
Lost him again.
Okay. That's all right. We can jump across to the next one. We'll always circle back. The true level of employment.
Yes. So this is a slide, Gareth. We've got the some of the Roy Morgan data, some of the ABS underemployment, and the ABS official employment saying that we're at 7.1. But obviously, when we've got our own treasurer saying that he doesn't actually believe the numbers, it's obviously a problem with our statistics, isn't there?
Oh, look, that's exactly right. And I mean, there's always been sort of question marks over the ABS printed level of unemployment, but everyone's sort of got used to it. No, well, you're just comparing like for like month to month, and therefore we'll just run with that number. But clearly, as a result of what's happened with COVID, that official printed level of unemployment has become, the unemployment rate that is, has become pretty meaningless. And so everyone out there is effectively calculating their own version of the unemployment rate that they want to use to kind of capture what's been occurring. So, yeah, a lot of analysts have been basically saying, if you look at where employment was in March, and then you take the change in employment, and then which we're down about 660,000 from where we were in March, and then you just effectively say that all of those people are now unemployed, because the ABS doesn't consider them all unemployed because they're not actively looking for work. But let's say you do that, that's effectively holding your part rate constant, and then an unemployment rate pops out from that, which in June was 10%. Now that's basically the unemployment rate that we're using when we're talking to clients. Now some people have taken it a step further and said, well, let's also add on top of that all those people who were considered employed but have worked 0 hours. And you end up with a higher unemployment rate. It's something, a bit over 11% at the moment. And that was the one the Treasurer was using when he said 13%, because he was actually talking, to the May employment report. I just have a little bit of an issue with doing that. And the reason I do is because every month there is always people that are considered employed but have worked 0 hours. And we've never made an adjustment for that in the past. And that could be because people are on annual leave, they're on parental leave, on long service leave, they're on sick leave. I mean, you name it. But the point is, they've always been considered employed and not unemployed. So if you start then making an adjustment like that, you're not really comparing like with like then when you're talking about the current new level of unemployment relative to where the unemployment rate is previously printed. And I dug into the ABS data on this, and if you look at the proportion of people considered employed in June who are working 0 hours, it's actually very similar to where it was in June last year. So that's why I'm reluctant to make that adjustment, just because you're no longer comparing apples with apples to do it now when previously we've never done that.
It's all pretty much semantics anyway, isn't it? I mean, we've got double-digit effective unemployment. Whether it's 13%, 10%, doesn't really matter. The fact of the matter is it's incredibly high. It's up there with prior recessionary periods. And in fact, it's probably even worse given that the rate of underemployment is so much higher now than it was in the early 90s or even the mid-80s. So, whether it's 10, 13, 15, doesn't matter. It's a massive employment shock.
Yeah, I would say, look, in semantics, it's whether it's 10 or 11, but it's important the way you're calculating it for direction. So in other words, if you're adding all those people who are no longer employed and you're considering them unemployed, so you're holding the part rate constant, then actually what you find is the unemployment rate peaked in May and actually stepped down in June. Whereas if you don't make that adjustment, the unemployment rate's going up. So in some sense, whatever level you're moving from is semantics. But then if you're trying to work out, are there more people today unemployed as to what was happening a month or two ago, then what you're doing is actually matters to what outcome you get.
Yeah, spot on. And also, Roy Morgan's data clearly shows that it peaked, I think, in May at about 15.5% using their measure, and now it's down to about 14.5%. It's come off a bit, but clearly we are past the peak.
Yeah, well, that's where our Jobseeker data has been really handy, because what we can look at the bank, and this is very high frequency, so this is daily data, we just see the number of CBA bank accounts that are receiving Jobseeker, and that actually, unfortunately, that's been drifting up now in the past couple of weeks. It was coming down in line with the fact that employment had gone up and the economy had reopened. But I think what we're seeing now in our numbers is that the lockdown in Melbourne has resulted in a new round of people losing their jobs, and so they're going back on Jobseeker. And it's going to turn out that a lot of those people, this will be the second time that they've had to register for Jobseeker in the space of 6 months.
Yeah, and actually the job ads data from Seek, and also Indeed, which shows Callum Pickering's unit, they've both shown that Victoria's had a big fall in job advertisements since the second lockdown. So that sort of plays into that whole narrative.
It certainly seems to me that the amount of unemployment. Sorry, actually, let me ask a question first on the underemployment first. That's probably the one we've been using a lot, is the underemployment plus unemployment as a figure to give us a handle on I guess the not only the number of jobs but also the volume that people want to be working. Have you got any thoughts on whether that series is showing similar distortions, or there's anything we should be looking for when we're using that series?
Yeah, so look, that series has been an excellent one, I think, to look at for several years now. Pre-COVID, it was highly relevant for thinking about wages growth, and the level of underemployment has had quite a good correlation with wages. And I think that's where, in a lot of ways, when the Reserve Bank, and again, this is pre-COVID, was talking about they couldn't work out why wages growth wasn't going up when we had an unemployment rate of 5%. So they completely ignored the fact that there's such a high level of underemployment, which means if you're trying to negotiate a pay rise with your boss, it's still hard because there's a lot of people out there who are looking for work in some capacity. So I've actually been a big fan of looking at that measure for a long time for that very reason. And I think, the level of underemployment in Australia is the printed level by the ABS is far less questionable than the unemployment rate, because it is basically just a question asked to people: are you looking for more? Are you working? And if you are you looking for more work or not, more hours? And so when people answer yes or no, that's a pretty honest way to collect information. And so I think that level is probably pretty accurate.
I've certainly been noticing, in my in looking at companies and what they're saying in terms of employment is, there was this first. I think it feels to me as if the first round was a lot of small businesses in particular, and people who had seen revenues fall, 90%, or the guys that have been really hard hit by the whole coronavirus. Whereas I think the bulk of companies that weren't that didn't have a 90% fall in their sales, sort of kept people on. But over the last 2 or 3 months, we just see company after company coming out, taking significant chunks out of their workforce. In terms of these, and I think these feel like more permanent job losses. In terms of if you're a restaurant that all of a sudden had to shut down because of coronavirus, yes, I'm firing my 10 staff. But if I open back up again, I'm hiring them. Whereas it feels as if you're a bank, or if you're Telstra, or if you're one of these big companies, you're looking at and saying, okay, I'm actually going to get rid of 500 staff here or 1,000 staff there. They're not coming back when we come out of coronavirus, or they'll be completely different positions if they do. Is that so similar to what you're seeing?
Yeah. So look, this was kind of always going to happen. The question was just how many of these jobs are actually going to see go, and a lot of it I think relates to the kind of pipeline of work that's there. And if you think about consulting companies, for example, they often have a pipeline of kind of 3 to 6 months of work, and then it's all about new work coming on as old work rolls off. And so as a result of the first shutdown, that pipeline of existing work was still there, but now it's not being replaced at the rate it's running off, and therefore you can cut hours, or you can. I know people that have actually taken a pay cut, but then at some point you're just going to not need as many people. And I think we're seeing a little bit of that now. Clearly, what's happening in Victoria means I think there's a risk that we get more of that now. And if New South Wales goes down the same path, then you're just going to see a further drop off in demand. I think that'll weigh more on business investment. And just confidence in the broader economy, which means those indirect job losses, if you like, are going to pick up speed. It's still very early days, though. I don't think we've seen a lot of them come through yet.
Now, in terms of the good guys, the WA and South Australia and Tasmania, sort of who are relatively coronavirus free, I guess in terms of demand levels and sort of where they sit in terms of economically versus prior levels, do you have a feel for, are we at 90% of prior levels or 95%?
Good question. I guess that our spending data sort of goes back to that, where we're cutting it up by state. It's just hard at the moment because we don't know. The levels look quite flattering, but as I said, there's those forces underneath them so it means we don't actually know what true level we're at. We probably won't know that until we actually see the official data. So obviously the national accounts for Q2, when they're broken up by state, we'll get a better handle on that. But look, my sense is that you're going to see things overall quite a bit better in Western Australia and Queensland than Victoria, but also than New South Wales as well.
I'm sort of more interested though in because if they're only getting back to 90% of capacity or 95% of capacity for what they were before, then that sort of gives us a better feel for how economy is going to come out of this. Because I guess there's one side of it's what do governments allow people to do, but the other part is what do people actually want to do, in terms of they do want to cut back on the amount of time they go out and spend at pubs or clubs, or the amount of time they spend in large stadiums.
Yeah,
can I add something to that? Sorry, just quickly. Sorry, Gareth. Look, New Zealand's probably not a bad case study to look at. New Zealand's obviously eliminated the virus pretty much. They've gone about 80 days without a community transmission, and their government has completely opened up domestically, but obviously they're not getting international tourism or or migrants, etc. But New Zealand's economy, according to statistics, New Zealand's rebounded to about 90% of former levels, so pre-COVID levels, and that's under effectively no lockdowns. So it gives you a bit of a taste about potentially where these states and where Australia could go.
Sorry, Gareth, did you have any thoughts as well?
Yeah, I don't think we're going to see anything quite as bad as 90%. I think somewhere like Western Australia could recover quite well, because quite a lot of the things that are with us to stay, for example, no foreign tourists for a while. They were never anywhere near as reliant on foreign tourists than New South Wales and Victoria anyway. So it wouldn't surprise me if somewhere like WA actually recovers quite close to pre-COVID levels. But when you think about other parts of the country, I think we're going to be well short for a long, long time.
Especially, say, Tasmania, for example, which is heavily reliant on Victorian tourists. So it's a bit of a different story by state.
Yeah, and the guys in WA can go to a lot more football at the moment as well. Don't forget that. So,
I'm going to pass on to the next one.
Yeah, sure.
Go right ahead. I'll let you lead this, Seth.
Yeah,
sorry.
Yeah, no worries. Well, look, Gareth, as you're probably aware, I know you read macro business. We're obviously very concerned about this. We call it the twin cliffs that are facing Australia from October. It's obviously been reduced since the government's kicked the can a bit, but as we know, we're looking at both Jobkeeper and Jobseeker being tapered from October. So Jobkeeper has been reduced from $1,500 to $1,200 for full-time workers and $750 for part-time. And Jobseeker is coming down from about $1,100 a fortnight to $815. Now, the Grattan Institute claims that this tapering, they've done a little bit of work around it, will reduce income support from $18 billion a month, which is about nearly 11% of monthly GDP, to $3 billion a month, which is about 2% of GDP for the 6 months beyond October. On top of that, we also know that loan repayment holidays were scheduled to finish in September, although the banks have said that they'll give some borrowers another 4-month extension. So that's another $266 billion worth of loans that have been deferred across both housing and small business, or 10% of total loans. So we're quite concerned that obviously the Australian economy has been surviving in a little bit of an artificial bubble at the moment, brought about by stimulus, by income support, and also mortgage and loan repayment holidays. Are you concerned about this? Or should I say, how concerned are you about the twin cliffs?
And sorry, the other one you've missed on that chart as well is the superannuation.
Oh, of course, yeah. But the superannuation is going to that will run through to the end of the year. But you are right. From presumably, if the government doesn't allow the emergency withdrawals of super, that'll come off start of next year. So we know that there's already been about $29 billion pulled out of people's super funds. But yeah, good point, Damien.
Yeah, okay. So it's the right way of asking the questions, and clearly it's a concern, but it's how big a concern is. And I'll play kind of devil's advocate because we're kind of thinking through things of a lens around, for a start, how will the economy? What state will the economy actually be in when the stimulus is tapered? And it's not being tapered right now, and clearly the expectation is we're not in a lockdown when that stimulus is going to be tapered. So on the basis that things don't get any worse with the virus, you would expect the economy to be in better shape in the fourth quarter of the year as the stimulus is being tapered. And all those businesses that are eligible to get JobKeeper now, if they still meet the criteria, they'll get it in the fourth quarter of the year. Now, they're not going to be getting as much as before, but as we touched on earlier, when you find out that 900,000 people are getting on average $550 more per fortnight than they were getting before COVID, then it makes total sense to reduce the payments. So, I think that the chart that we're talking about before with that huge lift in household income, that's clearly not going to be in play come the fourth quarter of this year, but equally it's not going to completely drop off the cliff either. So I'm not as kind of pessimistic as some that, tapering this life support is suddenly going to result in this huge contraction in household income, because the starting point of stimulus is so high anyway that we're coming off. And secondly, I think when we get to the time that it's being withdrawn, the economy will be in better nick than it is now. Now, it's not going to be anything like it was pre-COVID, but it will clearly be in a better position. And if it isn't, there's always the potential for the government to announce more. I mean, I think they've shown that they're willing to do that. And it wouldn't surprise me, in the October budget if more's announced.
Gareth, just on that, the question of timing is an interesting one, because, as we've sort of seen, even if the numbers coming out of Victoria today, this the whole corona piece is just it's a day by day almost exercise. So having these estimates in here, for want of a better word, I guess they're pretty rubbery in a way, aren't they? Because anything could happen in the next 4 weeks that means that they need an extension for another quarter perhaps. Is that something that's sort of factored into your thinking? Is that
Look, that's right. I mean, if we recorded this podcast or webinar, say 6 weeks ago, before Victoria was in lockdown, we might have been talking about a totally different outlook, and clearly that's changed everything. So things are so fluid that it's very hard, obviously with much certainty, to say how things are going to look. My kind of broader point is that if you look at what's been announced, say on the policy side, and just assume that you get no more, then at some point you're going to end up with a cliff, and therefore you get concerned. But is the government just going to let all these things roll off and do nothing about it? I don't see that being the case. So I'm my kind of working assumption is that if you need more, you'll probably get more, which means then you feel a little bit sort of less pessimistic around what a cliff may look like, because by the time you get there, there's more that's been announced.
Yes, and I guess part of that comes back to this whole when do we return to reality on you haven't been paying your rent for 6 months, your landlord can actually turf you finally, versus you haven't been paying your bills to your suppliers. When can the suppliers actually send you under or try and actually recover that money in a meaningful way? And I guess that's the question, as well as, I don't know, I sort of feel it's an interesting one about we've effectively suspended capitalism for a period of time, and is that going to be extended again for another 6 months? And if things aren't fixed within that next 6 months, is it another 6 months? And so what stage do you start pulling the good companies down as well, because they keep building up these debts to these bad companies that don't have the ability to pay?
Yeah, I think that's where the whole issue around the virus comes into play. It's why it's so hard to know, because even the government, I think it was the governor of the RBA, was talking about this analogy of building a bridge to get to the other side, and you can sort of get on board with that notion if you know how long the bridge has to be and what the other side looks like. But when you don't know when that's going to be, and the risk of you go through more lockdowns, that's when it becomes incredibly hard to know how long you can suspend a lot of these things, and how far can you keep it going before something breaks. I suppose the short answer on that is I have no idea, but right now we could probably get away with, if there's just this lockdown in Victoria and we don't get another one further down the line, we can probably get away with it where the economy can, I think, recover. It's going to take a long time, but a lot of this support will actually have worked, if you like. But I think if we go through this multiple times, then you're really stretching what you can and can't do.
I reckon that is a perfect segue to the next topic. What do you guys think?
Sure.
Yep.
Yeah. Okay. Well, I mean, so that brings us to the all-important point, I guess, about how the government should prop up the economy and how it should boost demand. Given that we're all pretty much in agreement that the Australian economy is facing years of underutilisation and a demand deficit. Now, Gareth, there's been a whole lot of talk about Australia should embrace modern monetary theory and et cetera, and alternatively, borrowing rates are the lowest on record. So the government can just borrow traditionally anyway. What sort of policies do you think the federal government should implement to not just give, I guess, emergency income support, but also stimulate growth going forward?
Yeah, look, I mean, it's a good question. It's a very open one. I mean, clearly the government is doing a lot already. The size of the deficits that were announced last week are just incredible. When you think it was not that long ago, the government was trying to eke out a wafer-thin surplus of a couple of billion, and now we're looking at deficits of several hundred billion. So I think they're already doing a lot in terms of trying to support the economy and keep it together, do what they can to boost demand. The traditional mechanism right now of borrowing money is working fine, issuing bonds and borrowing money. I mean, the Reserve Bank is there as a willing buyer of bonds, albeit that they haven't actually bought any for quite some time now. I think it was early May was the last time they bought a bond. But right now, you can sort of make the argument there's not really a lot of constraints on how much debt the government can go into. I think what's just more important is to get the economy back up and running to something like pre-COVID as quickly as possible, which is obviously incredibly hard. But they certainly shouldn't be worried about, I think, the size of the deficit at the moment. It's just not an issue.
Yeah, well answered, mate. Well answered.
But in a way, though, as well, I guess I'm quite interested in this whole, are you boosting demand or are you boosting supply? And if you are boosting demand, where's it actually going to as well? Because a government giving a $1,500 check to a pensioner who then goes and buys a flat screen TV freshly imported from China hasn't done a hell of a lot to stimulate our economy. I guess your thoughts on the types of policies that you're looking at going forward that are saying, yes, this will be a good thing for the recovery, versus the ones where you're saying, no, you know what, this is actually just going to be effectively transferring our demand across to somewhere overseas.
Yeah, look, it's a tough one. I mean, in a lot of ways, there's a bit of mud being thrown and you're hoping some of it sticks. I think it's not even just about boosting demand at the moment in the economy. It's literally, I think, giving people money to just ensure they can make their payments that they have to keep the machine together. So you've got obviously a lot of support going for people that are just then using that money to pay for rent. The government is not supporting them so they can go out and start purchasing new items that they wouldn't have otherwise. It is literally to keep things together, if you like. And I think that's the right approach. You've just got to do as much as you can to hold things together until the economy can just get on with it. The way you go back to a market-driven economy where it's the decisions of businesses and households which kind of give you your outcomes in a large way. But I think that while ever you're restricting activity the way we are, and Melbourne's obviously the case in point, then you can't on the one hand try and boost demand and at the same time say, well, these businesses are closed. I mean, you can't achieve both objectives. So you're just trying to patch things together just so you can get to the other side, if you like.
But so I guess we're just trying to go through what I guess I'm trying to work out what it looks like when every time we see an announcement. I guess it seems to me that there's a lot of, is it more money? Okay, it's more money, therefore it must be a good thing, versus saying, well, we're a fair way into this now. Now we actually need to make sure that it's being spent in the right area. So I guess what I'm thinking is there's one, say, for example, there's been a little bit of talk recently, should a WA business get the same amount of support now as a Victorian business, as an example? Or are we just in this to say, look, you know what, and I use that example of that K&S Corporation, having a $12 million increase in profit over the year on a $12 million increase in the amount of JobKeeper they got. There's the types of ones about saying, you obviously don't want too much waste, but at what stage do we get to, how soon does it need to be before we start to actually be a little bit more targeted and actually start to say, well, we can't give everyone the same support?
I think the JobKeeper changes, and JobKeeper itself does self-select to a certain degree because there is a turnover test, right? So obviously, if you're a business in WA and you're doing a lot better, you're not going to have the turnover falls that you're going to have in a business in Victoria. So it will be directed more to Victorian firms anyway. But I guess my bigger thing is the government has to obviously, as Gareth said, give emergency income support now to obviously stop otherwise viable businesses from going under. But then at some point, it also needs to kick the switch and switch from emergency income support to actually building demand in the economy. say through infrastructure investment, basically things that are going to give you the biggest bang for your buck.
Absolutely, yeah.
Providing a increasing job seeker permanently, so everyone gets a safety net. Just your old school traditional Keynesian type stimulus. The things I'm more worried about is, although I'd love it personally, is things like high income tax cuts, because as we saw with the first round of tax cuts, the household savings rate spiked, and that was targeted towards lower income earners. And whereas stage 2 and 3, the tax cuts are expected to cost about 100 billion, I think, and that's targeted towards higher income earners. And so you're effectively going to be giving money to people who really don't need it, and they're going to save the money. So you're not going to get the demand kick in the economy. Whereas if they undertake the traditional Keynesian type stimulus or raising Jobseeker, for people who are really struggling and will spend almost every dollar they earn, you're going to get a much bigger demand kick in the economy for a lower cost. That's my view. I'm not sure. Interesting, Gaz's views.
Yeah, well, you've got to have a different view, right? Because when you've got a couple of economists on, you need different opinions. And
absolutely.
I actually sit in a different place on the tax cuts. And I mean, it's already legislated policy anyway, so they're going to come in. It's just, do you wait for when they're due to kick in, or do you pull them forward? And I think there's a really valid case to pull the first tranche of tax cuts, as in the ones that arrive in 2022, to pull them forward, because what you've got now is you've got lots of people who are going to be working less hours than normal. You've got a lot of people who are not going to get a pay rise for years. Some people are taking pay cuts. And it wouldn't surprise me in Australia if we go into a period for the next couple of years of negative real wages growth. So I actually think the wage price index will probably end up printing below headline CPI for a few years. So that's going to result in basically a reduction in the purchasing power for a lot of households. And so I think in that environment, you can make a legitimate argument to pull forward the tax cuts, just so that basically people have kept up their purchasing power. I think the fact that they're legislated anyway means they're going to happen, and the cost of pulling them forward in the scheme of things isn't all that expensive.
Can I just ask a quickie? I guess it sort of relates to this. What's your view on lifting the superannuation guarantee to 12% from 9.5%? Anyone who reads macro business will know that I'm strongly opposed. I think it'll obviously drain household disposable income because people get paid less in wages, but also cost the budget more over the long run. Do you think it's a good move, or do you think that should be paused?
Oh, look, it should be paused in the current environment. I mean, you're going to have it's all a bit odd, isn't it, that you're giving businesses support on the one hand, and then you're telling them they've got to increase the amount of super that they pay into to their employers at the same time as you're saying some people can access their super early who have been impacted. I mean, it doesn't really all marry up. And the idea that at the moment that you would basically take money out of the economy, which is really what super is. It's pulling money that would have otherwise been spent, or it's taking it out and sticking into assets at a time when the economy is obviously going through the biggest negative shock that any of us have experienced. Just is wrong. If anything, you could be talking about policy that allows people to access their super to get greater access to their super now, not for people to stick more money away. So I think it's the wrong time, and you could argue it's just not the right policy at any time.
It's interesting when you're saying hang things together. I guess this is coming from my sort of take on when you have crises, there's a number of people who can take a hit, in terms, and the different factors of production, I suppose, is a way I think is quite an interesting lens to look through, where you can say, you can let the employees take the hit by making them unemployed, and then the spending power goes down, and you obviously get the negative effects because that sort of circulates through the economy. They spend less, and then other businesses take the hit. You can let the businesses, the entrepreneurs, so to speak, the equity owners take the hit. In terms of or debt holders, in terms of saying you shut the businesses down, and that's also got quite a big cost in terms of you shut a business down, and then a demand pops up for that business in a few months' time. It's not like there's people who just jump up and create those businesses. They actually take a number of years to get up and running. So you sort of don't want to do that phase too much. And then the last one is the sort of landlords, the people who own either the intellectual property or the properties themselves, to take a hit. And in a broad sense, from an economy, if they actually lose, if most of the burden falls on the landlords, then and they go broke, well, the buildings are actually still there, or the intellectual property is still there, or the factories are still there, and businesses can take over those quite quickly if things bounce back. And so it's bad for the individual asset owners, but it seems as if we've sort of reversed it and said, well, the landlords are actually, we're going to try and let them get out as much as possible. The entrepreneurs will take a little bit of a hit, but we're loading them up with as much as we can, and so a lot of the burden's then falling on the employees, which is then sort of having to bounce back on the government. And I just want to get your take on is, when you're saying hang together, which of these components are you looking at in terms of are most important for government to target in terms of making sure it hangs together?
Oh, I mean, it's a big broad question. I think everyone's taking a hit at the moment in some capacity. When I say the government's trying to keep things together, I mean, when you're telling people that they can't open their business, and you're telling people they can't turn up to work, you've got to have mechanisms there that mean the moment you say, all right, you can go back, that people have actually got something to go back to. And so I think more broadly that the suite of policies that we've got at the moment, they're far from perfect. And I think in hindsight, 2, 3, 5 years time, when people look back, we'll see that a whole lot of things were done that you do differently in hindsight, and you get some unintended consequences. But by and large, I think the suite of policies that we've got now is probably getting the mix about right between workers, businesses, and then lenders and whatnot. So sort of, I'm not sure I agree with you that the skew is kind of wrong in terms of who's copying the hit at the moment.
Mm. Well, I'll note as well that you obviously work for Australia's largest bank, so there's
Could you
probably,
tell?
Yeah.
But I
So the answer is going to be was always going to be.
although that said, Gareth's point though is correct. If there's nothing worse for the economy than otherwise viable businesses closing down, and taking 5 years to then replace those businesses and having all these idle assets, people, etc. So
yeah, no, that's my argument. Is let's say you took a restaurant as just a microcosm of the whole thing. Is you're saying, look, you can send all your workers home and make them all unemployed, but keep giving the restaurant owner enough subsidies so that when demand comes back, he can open up again and hire back those employees. And there's another part where you can say, no, let's let that business fall over, and then another restaurant will pop up. It'll take a while, but it'll eventually pop up. And the other one is you can say, well, no, you can let the owner of the property take the main hit, with a view that if you still got the people employed and the restaurant and the restaurateur, that if that person who owns the restaurant actually goes broke because they were overgeared or whatever and they couldn't handle the bit, then the property is actually still there. The business can still keep going on and paying whoever it is, the bank, if the bank now owns it or whatever, and the continuity is kept up. Whereas once you start firing people or you start shutting businesses down, you lose a lot of the continuity in the business.
Yeah, that's right.
Yeah. Anyway, let's not go too much. Housing market.
Let's move across to the property market.
So Gareth, I've left the best bit for last. Housing obviously is something everyone loves to talk about and pontificate about. Mostly me. Now, as we know, prices and rents are now falling especially across Sydney and Melbourne, being led by those two centres, which are obviously mostly geared to mass immigration, which has now collapsed. The way I see it, we've got the housing market's facing a barrage of gale force headwinds. Obviously, we've got high unemployment, falling household incomes. Obviously, as I just mentioned, immigration has collapsed. It's expected to be down by about 85% next calendar year. On top of that, we've got rising dwelling supply because there's a huge pipeline of apartments that are yet to be built in Melbourne and Sydney that still have to come online. On top of that, we've got a whole bunch of short-term rentals that are geared to the tourism market that have been smashed onto the long-term rental market, which has increased rental supply. As mentioned before, we've got mortgage repayment holidays and income support ending. So according to APRA, there was about 500,000 borrowers who deferred $192 billion worth of mortgages, which is 11% of housing loans for 6 months. Quite a large chunk of those are investors, many of those on interest only. And finally, although mortgage rates are falling, and you can get mortgages of around 2% if you get a fixed rate, the more important issue there is that banks appear to be tightening credit availability, which is obviously reducing the amount that people can borrow and also reducing the number of borrowers in the market, which other things equal points to falling prices. So the thing that I've been concerned about is that all these headwinds, especially in a nation of 1.3 million negatively geared landlords, could lead to a huge number of forced sales, which then leads to obviously a feedback loop of falling prices, which then creates more forced sales. Are you? I know a couple of months ago you forecast maybe a 10% fall in house prices over the next 6 months. Is your view on the housing market become more bearish, less bearish, or I guess what say you?
Yeah, sure. So we've hung on to that forecast of 10%, and when we put out that note, we sort of went through this was, I think it was in about April, went through all the reasons why we think prices will fall around that level, and then put a couple of scenarios around that and said, if we get on top of the virus quicker than expected as a country and things reopen, then we might see falls less than 10%, and equally, if we don't get a handle on that, then prices could slide more than 10%. And so you go back sort of 6 weeks or so, and it started to look like us that we might end up landing somewhere less than 10%, because according to CoreLogic data, house prices were coming down, but not too dramatically. And the economy was being reopened, auction clearance rates had kind of stabilized in the mid-60s. And so I didn't change the forecast at the time, because I thought there's still enough uncertainty out there. But obviously in the space of 6 weeks now, we're drifting back down to that, me being pretty comfortable with the idea that prices slide 10%, and then maybe if we're going through another lockdown or two, and nationally you'd be looking at something bigger than that. I think all of those factors you brought up before are valid, but for me, the single biggest reason why we landed at 10 rather than going more in terms of how far prices will fall is just the impact that the cost of money has on the amount that someone is willing to pay for a house. And look, even my personal experience, I got caught out. I got caught out on this, many years ago, when the economy was going through a soft patch as we were coming through the downturn in mining investment. I thought, relatively soft economy means that there's no rush to get into the housing market, because prices shouldn't be rising too quickly. Sure enough, the Reserve Bank started easing policy, and we saw this incredible run up in house prices. And I mean, the same thing happened over the previous 12 months, or not even 12 months, 9 months or so, leading into COVID. Was the economy was pretty soggy enough for the Reserve Bank to ease policy, and next minute, house prices were growing. There were some months that was between 2% and 3%. So I think prices will keep falling, but I think that just where the borrowing rates will provide a floor on how far they slide. And you did mention about tightening credit. I think if credit was to be tightened in any material sense, and that would be genuinely problematic for the housing market, and you'd expect prices to fall more. But I'm not actually seeing any evidence of credit tightening. I mean, if I look at CBA bank data, the average loan size that we wrote in June was actually significantly higher than the previous few months. So certainly on our data, there isn't any tightening going on.
Was that on what volumes though? On what volumes, Gareth?
Well, volume stepped up again on our book quite a bit in June. I mean, to be fair, they obviously came off a lot in April and May. But look, the impact of interest rates, I think, gets underestimated too easily on the housing market. And every reduction, 25-point reduction in the borrowing rate as you get down towards zero, has a bigger impact on the percentage change in interest repayments. So and look, I'm still talking about a 10% fall, which in any other point in time is actually a chunky fall.
Absolutely.
It's more that I just think you're probably going to need. I think you probably need a situation where the unemployment rate is rising over the next couple of years, rather than kind of stabilising and then coming down for prices to keep sliding, to where you get some people in that 15-20% range. I think you need a few other things on top of what we currently that sort of an outcome to occur.
Yeah, just on the cost of credit. Sorry, Dame, I'll just get this point in quickly. But that's actually one of the reasons why I'm actually, I guess, more bearish than otherwise would be, because for the past 30 years we've always had falling mortgage rates to buttress the housing market, whereas now I think mortgage rates are pretty much as low as they can ever get. And so we're not going to. So going forward, I'm talking about next year. Yeah, when we're no longer going to get the tailwind that we've previously gotten from falling mortgage rates whenever the market's gotten in trouble. So, but anyway, at the same time, we don't know. At the same time,
I would agree, and you can sort of make that the case that we're not going to get the tailwind on so many other things from monetary policy anymore. I mean, the residential construction cycle was previously highly dependent on the interest rates coming down to re-kick it, and where the cash rate is now, we're not going to get that. And so there's so many things that we will never get that kick until the monetary policy paradigm changes from the cash rate. But I just think the housing market is a really unique beast. I mean, you know all this, and there's such a momentum component too, and that can swing as well. And I think we're comfortable with the idea that they land down about 10% from their peak. I think you can make really good arguments one way or the other that it ends up less or more. But from our vantage point, I just think you need a few more dynamics on top of what we've already got in order for it to tip it to fall further.
Can I just ask, what's your view on the collapse in immigration? Like, how big an impact is that? Not just on the housing market, but obviously the broader economy. For me, I think it's huge. But what's your view on that one?
I think it's very big in certain sectors. So I think it's going to have a really material negative impact on residential construction. Because the whole resi sort of construction sector in Australia is set up for a certain growth in number of people year on year. And the more reliant you are on something, the more when it goes away, the bigger the impact. So I think it has a really big impact there. In terms of just prices for places, I think it's another factor at the margin that'll have an impact on prices. But to me, it's not. It just feeds into the mix as opposed to being something that really tips you into getting to those sort of bigger falls. And it comes back to me the borrowing rate, and with interest rates just so low, I do think it provides a floor on where prices land. And the other thing I wouldn't discount too is further government support for the housing market, because we talk about the Fed put, and you could argue we have a government put here on the housing market. And we've already seen a little bit of that more recently, just with stamp duty for first home buyers, the threshold increasing in New South Wales. And I wouldn't be surprised to see more first homeowner grants, stamp duty exemptions, whatever, if necessary, if it looks like prices are sliding at a rate which is too great but basically sliding at a rate that will then have an impact on the macro economy.
Honestly, mate, I reckon you can guarantee it. It's just, I guess the question is more, will it come too late? Will the government act early on it, or will they wait till we're closer to a sort of housing bust before they implement?
Actually, can I circle back for a minute back to you talking about saying higher balances on your loans, which I find very interesting, because we've sort of got one of the things which I think is a positive for the housing market is the uneven distribution of the nature of who's taking the pain. So mainly lower wage people were taking the pain, and higher wage people are more likely to be able to work from home and keep their job, and are stuck there not being able to do your annual trip to wherever to Japan or to the northern Alps of Italy to do your skiing trip, and so there is that sort of extra money being built up. And do you think that there's a factor in that in terms of higher balances for your loans the bottom end's falling away a bit, and it's being the middle and the upper end is filling it in?
You mean balances in the amount of money that people owe, or
the borrowing? So you spoke about being a higher average amount borrowed for June.
Yes, that's right. I'd love to pull up that chart because I just want to confirm what level it was relative to previous months, but it was definitely up. And look, I really don't want to offend anyone with a statement like this, but if, at the risk of generalizing, if you look at the kind of profile to date of the kind of jobs that we've lost and the people most impacted, it's a higher skew towards younger workers. It's a higher skew towards people who are in casual employment on not fixed hours in and the industries that the job losses have occurred at to date have been well documented. You ask yourself the question, what proportion of those people were in the market to buy a place pretty soon anyway?
Yep.
And you might find it's quite small. Now, clearly, the situation changes if we get second round job losses that were not in those direct industries impacted by COVID, and you see kind of middle to higher income earners losing their jobs in consulting firms and whatnot. That dynamic can shift a little bit, but I think to date that's also probably one of the factors which has meant that prices haven't been sliding too quickly, is because the people, as a generalization, who have been disproportionately impacted were never in the market anyway to buy a home.
Yes. Oh, mate, you're spot on, because typically prices are more volatile than rents, but what we're seeing at the moment is actually rents are sort of falling away faster than prices, which is really unusual. And the reason for that is the job losses at income, well, not the income losses because of Jobkeeper, but or Jobseeker, but the job losses have been concentrated in those sort of younger renter demographics, as well as the loss in obviously the international student trade, who new temporary migrants tend to rent as well. So that certainly plays into your point that that the pain's been felt in the areas which of the economy from people who are less likely to actually be looking to buy a house. They're more likely to be renters.
The other part that I guess has come through, and it's sort of we're getting pretty close to the end, obviously, but it's in terms of what you're saying, is I guess we've sort of had this view that this economic boom was getting pretty long in the tooth, like globally, and debt build-up had been quite extreme, and that we were waiting for what was the what was the pin that was going to pop the bubble? What was the event that was going to cause it? And I guess we're looking at this through that lens in terms of saying we're looking at the downturn as being the economic shock of the coronavirus as being happening at the wrong part of the cycle, and that's what's going to drive. That's probably the main part of what's going to drive it down, as opposed to just the shock. But it sounds as if you're more of the opinion that this is a temporary shock, and that we will be able to get back to similar levels to where we were before, and that I guess that the cycle, so to speak, in terms of debt losses and things like that, has actually got further to run.
I think this could be the very last part of it. So, in other words, it's going to run for a little bit longer. But if you think about, say, the longer term debt cycle and the interest rate cycle, it's very clear that we're kind of getting towards the end of it, given that interest rates can't really go any lower. And which means that there's a natural limit then as to how much debt people can be taking as a share of income. But for me, that those last interest rate cuts that we got from that really started in the second half of last year, and then we had a few more this year, that just gives you that's that final, if you like, impetus to allow people to borrow a little bit more, and that I think feeds into the view that house prices they're still going to fall quite materially. I mean, 10%, as I said, is a big deal, but they don't go too low. But I think if you're going to think about the framework for the economy for the next 5 or 10 years, then this is a whole different kind of topic. But there's no question that we're drifting into a new paradigm. We don't know what that'll look like, and we don't know what role central banks are playing in that, or whether or not the framework changes. We'll have to wait and see. But certainly the way we have done things previously, where we can deal with negative shocks to the economy largely with monetary policy, is just not going to be the case from here.
But I guess in a traditional cycle, we go through the boom, then we go through a bust, and in that bust we get quite a large deleveraging. that bust for at least for consumers and for businesses. Maybe not governments, but then you sort of up you go into your next cycle. But it seems as if we're not getting the deleveraging part because we're actually building up just more debt because we're just saying to people, would you like another loan with that? And we're not letting companies go broke. We're not letting, keeping people from insolvency. So I guess that seems like it to me, under your view, that's then just going to create a bigger problem at some stage. But that's a number of years away. Is that your?
Well, I think we're doing the right thing at the moment. Is you don't want to let businesses go broke because a lot of them, through no fault of their own, have had a hit to sales because the government has told people that they can't go and consume and spend in that person's business. So I think we're doing the right thing, and you've got to do what you can. But I think from a cycle perspective, it's only when we get through this over the next kind of year or two that then you might start thinking about what do things look like from here in terms of how much debt should government be taking on a regular basis, and when do you then let businesses fail, and have we reached the point where household debt just cannot grow anymore, and what does that look like? I think all those things in a lot of ways are a conversation for another day. I think right now though, you do whatever you can so that when we finally get a handle on the virus or there's a vaccine or whatnot, we've got as most of our economy intact as we can manage.
Okay, excellent.
Very good. Well, I might just do a quick call out for those listening in live to pop any questions in. We've got a couple to go here, but we can jump into the investment outlook and then wrap up with some questions.
Let's just jump to the questions.
Questions now? Okay. Look, there's a couple of here. So we've got, where do you see the AUD going in the short to medium term? And if there is another US stock market correction, do you think the AUD will revert lower?
Sure. So our call on the Aussie dollar is that it's got a little bit further to run higher, not a lot, but a little bit further. I mean, the commodity prices have been pretty favourable for us. We're running now big current account surpluses, and the RBA is not putting any downward pressure on the Aussie with what it's doing. I mean, it's got a yield curve target, but it's not actually buying any bonds. So we think that the Aussie is going to stay pretty well supported from here, and it also looks like the US dollar's just on a downward trend. I should sort of say that I'm not an FX strategist, and we've got guys in the team that do that specifically, but that's their view on the Aussie at the moment.
And sorry, that was versus the
versus the US dollar,
versus euro. Is that because I guess that's what, to me, certainly most recently, I guess the Aussie's been rising against the US and falling against the euro. So it's sort of been more US dollar weaknesses. I guess a bit of it's been, I think, earlier on, but the last month or so, a lot of that's been US dollar weakness and euro strength, and so the Aussie sitting in the middle. Do you know what that's
true. I can't remember though what our forecasts are for the Aussie euro cross. Yeah.
Okay. No worries. Let's do you want to jump to the next one, Tim?
Yeah, that's all right. Thanks for that. There's one here actually, and I won't get you to speak outside of what you're allowed to. But a question here: what are the banks? I guess whether it be CBA or in aggregates exposure to CLOs, so collateralized loan obligations offshore?
That's well out of my domain. I don't know.
All right, fair enough. No, that's fine. We can take that one.
We'll do that one when we have Jonathan on board. But I think, yeah. Anyway, actually, we'll pick that at another. Do that one another day.
Yeah. Okay. No, that's fine. Do you want to just jump into a quick investment outlook wrap up, Damien?
Yeah. Sure. Yep.
Right.
So, So look at our key factors that we're looking at is unemployment is the number one issue. And obviously, Gareth gave us some interesting views on his thoughts there. I think some of his comments are certainly true in terms of saying, look, we're in the fog of war at the moment, and we're building this bridge through the fog, and we don't actually know how far we have to build the bridge. And there's a question as saying, well, at what stage do you give up on building the bridge and you build a boat instead? I think that at the moment we're obviously still trying to build that bridge and trying to limit the number of as you said, the number of companies that go broke, limit the number of people that sort of lose track with their employer. And our sort of take is that was a very good short-term view, but the longer this goes on, the worse that is as policy, because it means that you just have people sitting there for longer and longer. And so there is this bet on will we have a quick recovery and a slow recovery? I think our view is still very much that looking at the New Zealand example, back to 90% of what they were before, is sort of is your good case. And we think that it doesn't. A lot of it doesn't come back to government policy. A lot of it actually comes back to people's choices. And so we'll still think that getting that feel on how far earnings are going to fall and recover is still very important. In the latest reporting seasons, we've seen companies coming out with numbers that are sort of 20-ish% down on prior years. A number of them have quite steep bounce backs, and a number of them have quite long drawn out recoveries, and so trying to get a feel for that is difficult at the moment. We're sort of looking at a lot of the current year numbers, and the first forecast year is being relatively useless, and we're sort of really focusing on this whole, where was the 5-year average, what's the second year of forecast, so it's looking at 2022 numbers and trying to work out how much sense is in those numbers from analysts, and as to which companies we're quite selective as to which companies we're trying to buy in this environment. I think there's certainly ones where if we think they have steady earnings and even if they've got a bit of gearing, a bit of debt, we're actually not that concerned about it, because if the earnings are steady, interest rates are staying low for a long time, and that's going to be a way for people to make some extra profit on an extra returns. But the flip side is, if you can't afford your debt, then sitting on a huge pile of debt is obviously going to be extremely negative when reality comes back. And so so very much just looking at the safety trade and trying to work out where we can find companies that are that are giving us the best mix of that quality companies with at reasonable valuations. Leave it at that, Tim.
Okay, yeah. Actually, just one last one for you, Gareth. It sort of ties in a little bit with our guest for next week. But I spoke a little bit at the start there about obviously we've had this sort of probably one-off annualised deflation figure or negative inflation figure. Just your thoughts on, I guess, the prospect of inflation going forward in the sort of short to medium term. And I think you mentioned, or you did mention earlier, that you're sort of figuring a fairly low wage growth rate over the next few years. Obviously, wage growth and inflation generally causally linked. So I just was wondering if you could give us a bit of an idea on inflation, Gareth.
Yeah, sure. So obviously in the CPI we got yesterday, there was a few one-offs which are going to be reversed. So that big fall in the CPI of 1.9% was driven largely by free childcare, petrol prices coming up 20%, and then some free preschool, I think it was. So we'll get a lot of that reversed in Q3, but without question, we're going to be in a low inflation environment. I think for quite a long time, unless something materially changes on the monetary policy side. I think though, what might be interesting is that within the CPI basket itself, I think we'll see some quite unusual volatility going forward. It wouldn't surprise me if you see prices spike for the kind of things that government has effectively imposed limits on, and I'm thinking there. Hotels and restaurants and whatnot. I mean, as we go into spring and summer, if we've still got social distancing requirements and limits on the number of people you can have in pubs and clubs and whatnot, I think the amount of people who want to get into a restaurant or pub will far exceed the number of people that the business can actually sell to, and therefore the natural response is to raise prices. So
$40 Palmer.
If you're going out these days at the moment. To a pub for dinner, you probably noticed that a lot of the specials that are normally offered have been the venues have gotten rid of, and there's a little bit of that. Yeah, so I think we'll actually see a little bit of that. When you drill down into the basket going forward, some just quirky little things like that. But I think overall inflation's going to be very, very low. And as I said earlier, it wouldn't surprise me if we see quite a bit over the next couple of years where the headline CPI is actually printing above where the wages are growing at, meaning for a lot of households that we're in a period of negative real wages.
Okay, very good, and quite concerning. Well, look, thanks very much for joining us today, Gareth. Would you mind just sharing, if you like, with our audience, just ways they can follow your work and track what you're up to?
Yeah, sure. So, I mean, anyone who is a client of the bank, you can get on our research distribution list. So you're welcome to send me an email, gareth.aird@cba.com.au. I mean, I'm in a research team that publishes a lot of stuff on all sorts of things, really, the economy, financial markets, the standard stuff, really, that bank economic research teams do. So, anyone's welcome to send me an email. We can sort that out.
Fantastic. Look, thanks again for your time. We've gone plenty over, but it's a massive topic, and we look forward to getting you back on the show very shortly there, Gareth.
It's a pleasure, gentlemen. It was good to have a chat.
Lovely. And thanks to you, Leith, for tuning in and chiming in, and Damien as well. We'll jump across to our question of the week for listeners and viewers. So this week's one is: do you believe Jobkeeper and Jobseeker should be kept at their current levels or cut cold turkey? I think we pretty much covered off on the panel's views on that during the show, so we don't need to go to them. But feel free to drop in your answers in the YouTube comments of this video, and we can run through those. Coming up next week, we have another special guest in Jeff Booth. So Jeff's an entrepreneur, technology leader, and this year is the author of a new book entitled The Price of Tomorrow: Why Deflation is the Key to an Abundant Future. Jeff joined us this week for a pre-record to discuss some key themes in his book, including technology-produced deflation, future uses of energy, 3D printing, and the many uses of artificial intelligence. It was a terrific interview, and I strongly suggest checking it out. It'll be available at the usual time of 12:30 Australian Eastern Standard next Thursday, so check that one out. And just finally, of course, we hope you enjoyed today's show. If you'd like to see more of our content, head on over to nucleuswealth.com/content. To stay up to date with the news from us, and follow us, of course, on social media. We always appreciate guest or topic suggestions, so if you've got one, please drop them in the comments of today's YouTube video and we can follow that up. And of course, just finally, if you know anyone who'd get something out of today's podcast or episode, please feel free to share with a friend and help our podcast grow. So look, got a big show today on a massive topic, and really appreciate everybody who's listened in, and for those that ask questions. And of course, we'll look forward to